Good afternoon, folks. It's Daniel Rashid. Thanks for tuning in again. We're going to talk about your credit score, and knowing more about this is so beneficial for you in all walks of life. Be confident about your credit score, and knowing how the two major credit bureaus evaluate your credit score will be beneficial for you to improve on that score and to sort of know what they're evaluating it on, so you know what you can do to increase or make your credit score better. Your mortgage is all based on that. It's the first roadblock for you if you're getting a mortgage on anything you do, or just lending in general on anything you do. So the two major hey, stop it, stop. The two major credit bureaus in this country are Equifax and TransUnion. They use a credit score system called Beacon or Emprica, I believe. And that's sort of like their evaluation systems on everyone in the country in terms of evaluating their credit score. The credit score is broken up into a few different pieces. So let's get into it. The first thing is your past payment performance. It encompasses about 35% of your credit score. And this is basically straightforward. Make your payments on time, and make sure that you don't owe any money to any of these companies, so there's no judgments against you. Think of it in titles, it goes back about 2 years. So if you can hold strong for 2 years, making all your payments on time, whatever it is, even if it's minimum, it's not really highly suggested, but at least you're making those payments. You could there's a lot of different platforms now, like auto payments on your banking system or whoever you bank with on the app. You can do an auto payment every month of your minimum payments, and that will keep on top of that. So control that value, for that 35% of your credit score. 30% of your credit score is going to go into credit utilization. So, how much are you owing on your credit cards? Is it a large balance of what's available? So if you're sort of maxed out on your credit card a lot, it's not that good. You want to keep below the 50-60%, and you want to keep that number down. It's almost better to have more credit cards and be, your utilization of your credit to be like half of what is available on those credit cards rather than like one or two credit cards that you have maxed out constantly. The more credit you have access to that you're not using is evaluated as a good thing. So it's sort of like, some people cut up their credit cards and they toss them. It's almost better to keep them but not use them as much. If you not use them at all, if you can. And then that would be, don't get any credit cards with an annual fee. Doesn't make any sense unless you want some perks and stuff like that. But that's the idea. So if you had a bunch of credit cards and you sort of kept that balance in the middle of the road, you're much more better position, because then you're going to have more payments on your file. It looks like you're not using all that credit that's available to you, that you're responsible as a candidate. So your credit score will increase. So that's 30%. 30% of your credit score is going to be evaluated on that. Next thing is your credit history. So the more history you have, the better. You can't just open all these accounts in 6 months and have a killer credit score. You're going to, have to have these accounts open for some time. So if you don't have a credit card, you should get one and just not use it if you don't, want to dip into there. But, actually, you kind of have to use it, and then just make your payments more frequently. You got to build a credit score. Unfortunately, they want you to draw credit because a mortgage is definitely just like a big loan. So they want to evaluate if you, as an individual, can pay back the loan, essentially. So credit utilization is important. Start creating a history for yourself. Even a car loan's a history. A phone is a history, because you usually have a term with that. And that does count as a payment, counts against you. But, phones are necessary in today's world, and if you can make it happen without a phone, good for you. There may be a way around it. There is a lot of social platforms that you could use, so maybe you can save some money. So that's 15% of your credit score. Type of credit is the next parameter that's calculating your credit score. So this stands for 10% of your credit score, and it's for instance, like a buy now, pay later card or account with a depot store would be considered a high risk, just because you're sort of building up that lump sum payment towards the end of that loan, and the bank will view that as a high risk, as opposed to maybe a revolving credit line that's halfway drawn, or just another account in general, not like a high interest account like a credit card. A low interest credit line wouldn't be considered as high risk as a buy now pay later 29.9 or 35% card that will churn over if you miss those payments. So that's something to be aware of. It does only stand for 10%, but don't take the risk if you don't have to. Inquiries is the last one, and this stands for 10% of your credit score. I've been told mixed things on this. Most mortgage brokers and bankers have told me that doesn't really affect your credit score. But if you're going to different furniture stores and you're trying to get a higher, high interest loan taken out, sort of credit card, and buy some furniture with it, and you get declined from a numerous amount of stores, or you decline from a numerous amount of different dealerships, like car dealerships, for what have you, that may be seen as a bad thing on your profile. And I mean, you need to ding it a lot. You need to ding it in terms of meeting with somebody and them drawing up your credit score. It usually has a history of that. So if you start, 20 different lenders and you're really being aggressive about it, it's going to hurt you, 10% of your score. Now, that being said, it's rare that you're going to go to 20 different people. I mean, I don't know, unless you're really motivated to get something, like a piece of furniture. But if you're buying property, from what I know, it's not really going to hurt you as much if you went to a couple different banks or what have you. All right, so for the instance of that, pretty much encompasses your 100% of your credit score. So when you're meeting with your mortgage broker, just a couple rules of thumb. Be honest about your file. If there's something that's like in the background that is happening, just be honest and upfront about, maybe money owing or judgments against you. Your best policy is honesty. Honesty is your best policy. So be smart about that and just be honest with your mortgage broker. They're going to work hard for you. So don't sweep anything under the rug, because things will just reveal itself later, and it could cause a lot of problems for you purchasing a property. In the last second come closing, if the underwriter finds something, a deal could be held up, and if that seller wants to not support your amendment to extend your deal, they might just take your deposit, and you might be on the hook for even more. So just be honest and open, especially when you're dealing with the people that are in control of your money. Now, I did say about 50% before, in terms of your credit card debt. If you can even keep it less than that, 30% of your total balance of what's available to you, that's going to skyrocket your score. So try to keep it below 30%. If you're holding on to 80% or more constantly, it's just going to hit your score. And that stands for a big percentage of your file. So I think it's 30% is what I discussed. Be smart about that. Keep that payment down. All right. At the end of the day, keep the big picture in mind. Plan ahead. If you're going to make an impulse buy and that's going to cause a major ding on your credit history or file, so keep the big picture in mind. Evaluate what credit decisions are important to you. And the high risk ones, you may want to just hold off on that unless, if you're planning to buy something in the near future. At least get the ball rolling first, and then you can start being a little lavish if you want it. But being lavish prior to your first purchase is not a smart move. They're going to evaluate you pretty hard. So just be careful, with your draws. I mean, everything is so attractive, and emotionally you can get drawn into wanting something really bad and make a decision that you don't have to pay right now, but you got to pay later. Be wise about your decisions and what you draw out on. Identity theft is on the rise these days and has been for years. Having an account at Equifax or TransUnion might cost you a little bit. There might be monthly plans that you can pay every 6 months, just for a month. Might be smart that way. But checking every 6 months isn't a bad thing. Just because you can kind of keep an eye on things. And a lot of people have similar names, and some brokers, somebody in the US, what have you, may not, it could be an honest mistake, it could be a fraudulent mistake. But someone could draw something on your account and really drop your credit score. And that's just something that just, if you're on top of it quickly, to resolve that takes time. So if you're on top of that quickly instead, rather than the last second, it's much better for you. You'd be in better position to kind of sort that out. Hopefully it doesn't happen to you, but it could. So every 6 months is what I would say. Check on your credit, especially the cost is low, and you can kind of keep an eye on things. You can kind of see where and how your credit's improving. Some of the apps on your phone, like banking apps, have like a free check, which is good to see your score, but doesn't really provide you much more information than just seeing your score. It's good to keep track that way, free. You don't have to really pay much. I know mine does it quarterly. There's different banks that do it on different terms, but you don't have to pay so much. So that's not a bad thing. Again, your two major players are Equifax. I would suggest you look them up, and TransUnion. They play off each other. They're the only two in Canada anyways that are going to draw on your credit score, or that you can sign up for to kind of view your credit score. Check them out. At least get a month, see how this whole process works, and what a banker is going to look at or a loan officer will look at when you're trying to evaluate, or when they're trying to evaluate you for a loan. Okay, so from the top, to recap what I discussed, past payment performance stands for 35% of your credit score, and credit utilization stands for 30% of your credit score. Then we get into your history, so your credit history, that's 15% of your credit score. And if you need more explanation, just dial it back in the video and check that out. The types of credit being used is 10% of your credit score, and then it's inquiries for another 10% of your credit score. And those are the main factors that are deciding the total, your total score at the end of the day. You learning more about that will give you an edge when you're buying. So take the time, educate yourself, view your credit score. You don't need to know every parameter, but having a general idea of how to improve it is always a good thing. Because sometimes we're doing things honestly, and we could probably just change it up or move some money around, and it will be better for our credit score. And there might be cards you're not even using that are just costing you monthly, so it's not a bad idea to check it out. Again, this is Daniel Rashid. Thanks for taking the time to watch this video. Hopefully this will help you in your endeavors, and let me know if there's something that you want me to cover, or any questions that you want me to ask, or ask me so I can answer them. Like and subscribe, and I'll catch you on the next video. Take care.